Good evening. I hope everyone's looking forward to tonight's webinar where we showcase faculty members from ASEC Asia Pacific's master programs. You will hear from our esteemed professors and academic directors who will explore an array of subjects from economics to marketing and finance. First up, presenting luxury brand management is Professor Sonja Prokopec, who's also the Associate Dean of Faculty at ASEC Asia Pacific.
So hello, everyone. I'm very pleased to be here and to share a little bit about what I do in my area of expertise with you. So I will just share some slides to make the process more visual, because you will see something that is part of my area of expertise actually is a lot more interesting with images. So I'll share now. So yes, so I'm a professor of marketing. I have been with ESSEC for 15 years. 6.5 years have been in Singapore campus. And even though my main area of expertise is, well, it's quite broad within consumer insights, consumer behavior, I have over the years specialized in basically working with the luxury industry and really understanding how to manage luxury brands. And this area is very interesting because even though luxury industry is a very large industry with the many leading global brands now in the world, it's also an industry where a lot of insights can be drawn from and can apply to really strong branding practices. So this is how I approach this subject and how I teach it and how I work with companies that are basically looking to premiumize their branding, to premiumize their experiences, or with companies that are targeting luxury clients and need to understand how these clients behave, what they think, and what they like, right? So that's the approach. So even if you're, for example, in an area which is not within the luxury field, you can still find a lot of really interesting takeaways in terms of how luxury brands are managed. So one of the fundamental principles comes down to the branding pillars or the framework that is utilized in luxury brands, even brands in the fragrance industry, for example, in the makeup industry, like you have here on the left, and some of the FMCG brands that we have on the right, which still can have very strong branding, marketing activations in place, but don't necessarily follow the same rules as luxury brands follow. Okay, so usually within the luxury brand management, we'll say that there are 6 key differences or pillars in terms of how to manage luxury brands. But because this is a short masterclass and I won't have time to develop all of these, I will just focus on 3 pillars that are interesting to start with. So one of the first pillars comes down to really the fundamental that you need to consider when you are thinking about premiumizing your brand is the brand DNA. And I'll start with this example because I think this example resonates with a lot of people. So imagine these are 2 cups of champagne, and they represent 2 brands. And usually in a more interactive format, I would ask, well, what brand do you think is on the left? And what brand do you think is on the right? And the audience, will do some guesses. They might try to guess, but at the end of the day, unless you are able to taste it, and even in that case, unless you are really an expert in champagnes, most of the time, we will not be able to tell. Right? So how do you then decide once you are in the supermarket or in the specialty store, how do you decide which brand you should go for? it really comes down to that branding element. And that branding in the world of champagnes, in the world of wines and spirits, is some of the most sophisticated branding in the world, because fundamentally, the product itself is not different. It might be some nuances, and maybe the experts will say there are substantial differences. But to an average consumer, these differences are really not visible, right? So this is the first pillar of this brand DNA, is really the fundamental luxury, strong luxury brand management. So what is this brand DNA? Well, the brand DNA is the same way we as humans have DNA and define who we are. The same thing, you can think about it in a branding concept. So it is really what differentiates the brand, but how it's different in the luxury world is that it's not just one or two components, because that's very limiting in terms of how you can define your brand, but it's actually more rich than that. The brand DNA is defined as usually 4 multidimensional elements that are uniquely combined. And these 4 elements can come from brand origins, from specific know-how, from heritage, from the founder, from the craftsmanship, the specific craftsmanship that the brand might possess, or specific values that the brand holds. So there is not a mathematical formula to it, but there is still a very methodical approach in how you would define a brand DNA. It can be linked to the founder's founder himself or herself, to the culture, to the place of birth, to the brand concept. As I said, really where these 4 elements come from, there are many possibilities. What is key here is that these 4 elements combined are unique to your brand and no other brand. And this idea of uniqueness is very strongly present in luxury brand management. There is no positioning by comparison. There is only positioning by uniqueness. So at the end of the day, this brand DNA is like a trunk of a tree, and you are deciding how wide and how the tree should look like before you express it to your consumer. Okay, so it's really a defines the strategy and dictates everything that you should do, but it also dictates what you shouldn't do. Okay. So if I'm giving you an example of one element of a brand DNA of Louis Vuitton, one of the elements of brand DNA of Louis Vuitton is art of travel. And this comes from the historical, basically, beginnings of the brand, and why this art of travel is so fundamental to the brand of Louis Vuitton is because the founder himself was his first job was a packer. He was packer for the wealthy at the time. This was in 1800s. And he was, his first job before even starting to create trunks was to pack the wealthy. So he really understood the needs of his customers at a time, and then he started creating trunks which were addressing the needs of the wealthy, right? So this idea of travel and art of travel was really inherent to the brand at the very beginning, and the brand took that element as something that really defines the strategy in terms of what they do, but also in terms of how the brand expresses themselves. Okay, so not just referring to the products, even though you see here images of products like trunks, like luggage, like bags and handbags, but also to the way that the visuals that you see that are expressed what the brand is about. And so in that regard, this leads to the second point of what is unique about luxury brand management is this idea of brand codes. Okay, So I spoke about brand DNA briefly, and brand DNA is something abstract. It's not visible, but it is something that has to be as known by all employees of the brand and really part of the brand strategy. Okay. Now, how do you express that brand DNA is through two ways. The first way is the visual identity, which is expressed through the brand codes. And this is really how you implicitly brand your products through these visual codes that are also linked to the DNA, an expression of the DNA, but visible expression. Okay. And the second element that I will speak about in a couple of minutes is storytelling. Okay. So the stories you tell about your brand, about the codes, about the history. Okay. So what is interesting here is that here, this branding via codes or visual codes is really implicit. It is not something meant to like logos, even though logo is a code, but these are much more subtle elements of branding where you are, where your products are recognizable from the position of cultural capital, as opposed to, through mass visibility, like for example, logos or large scale brand names. So I'll give you some examples because I know it can be sometimes challenging, right? So shape. Shape is a code. It's a visual code. You can often brand through shape. If you look at these in a normal session, we would be interactive session. I would be asking you if you know these brands. But here you have codes like shape, which work really well in perfumes and fragrance sector. Like here you have Jean Paul Gaultier, that is a recognized perfume shape. Then you have Celine, that has many bags that have become recognizable through the specific unique shape that they have. You have Rimowa, that is a luggage company that has a very recognizable shape as well as a kind of architectural shaping on the suitcase itself. In terms of the bottom label that you see, this is for a brand Dom Perignon, and it is a unique shape of the label that you can recognize that you can recognize even if you don't know the brand. And finally, you have here a bottle of Hennessy cognac, which is also a very unique shape. I see here a question from Kanishka that says, is the company motto a part of the brand DNA or brand code? No, brand motto is not part usually of a DNA. It could be focusing on something to express the part of the brand that you want. But brand motto is usually not a part of the DNA. It is also not a code. Okay, codes are visible. So they are usually visible or they are sensorial. So they might be a smell or a certain texture, but it's usually what you see, what you visually see. Okay, so that's the code. Okay, some other examples is here you have examples of prints. Prints are a very good example of a code. You have here Emilio Pucci, and then you have Goyard, and then you have Dior. And these are prints which are, of course, unique to the brand. So codes definitely have to be unique to the brand. They cannot be related to the category. Some other examples I can share with you, even though there is a lot more, is packaging and color. So color is an important code, probably the most popular code that you will see, but definitely not the only one. So you have, for example, Louboutin as a bottom of the shoe, the red on the bottom of the shoe. Tiffany's with the Tiffany blue. This is a color that actually patented and protected by Tiffany, so no other brand can use it. Black and white by Chanel. Sorry. Then we have the red of Cartier, the jeweler, and the orange as a color of Hermes. Besides the color, I think I don't have more images, but I can, for example, it could be an animal, like Bulgari uses the code of Serpenti, a snake. There is a bee or of Gucci. There is a panther of Cartier. So there could be metal, certain metal shapes or hardware that you use as a brand code. So really the possibilities are quite vast. It comes down to the fact that is it visible and is it recognizable as something unique, only linked to your brand, right? And the last element, and I will share it very quickly because I only have a couple of minutes left, but it's important for you to understand the three elements together, is, as I said, you have the brand DNA, and that brand DNA is internal. So, for example, Art of Travel is combined with the DNA of exceptional quality of products, and two other elements of Louis Vuitton. It is expressed through the visual codes, like in Louis Vuitton, you have the monogram, you have the damier, you have the certain buckles, gold buckles that they have. So you have at least 6 to 8 different codes that they utilize. You have certain colors that they have, and at the same time you have the storytelling that is that comes and with the brand, and that is really embedded into the products and into the brand experience. These things are not separate. They're not a separate part of the brand. They're all embedded together to create the brand universe that many customers around the world admire, want to buy into, and are extremely loyal to these brands, right? So this dream that the brands create in the luxury universe is very strong. So the last pillar here is the storytelling, which gives this link among the products and really creates a complete lifestyle. Here, a great example is Dior. Dior is entirely built around the vision that Christian Dior, the designer, had for the women. And so the DNA is the vision that Christian Dior had himself. Now, what's interesting is the story is a myth because he died a long time ago, but the brand is built around his views and his vision of femininity. So you have many codes in the brand, and I will show you how those codes are actually not just randomly chosen, but they are actually really built and inspired from the life of Christian Dior, right? So let's say, so here you have, these are all the codes on this bottom. Some of them are very frequently seen codes, some are less frequently seen, but they nonetheless are very important to the brand. And so I'll give you an example of his some of the things that we know about Christian Dior is that this story is all around his creations and his vision of femininity. Many elements are chosen from his life or his tastes, his decorations, his likes and dislikes. He, for example, loved gardens and he loved flowers. His favorite flowers were roses and lilies. So those are the codes that the brand uses. Then, for example, he was very superstitious. So he believed in the stars and the planets and needed to make sure that all the stars are aligned. So because he was so superstitious, and he created his Dior house after finding a star in the street. The star itself is a code of the brand. So you can see that you can't actually separate the code from the story, and the story from the code, and they are a way to express the brand DNA. And the last example I will share with you is that here you see an example of a code and how that code, what is the story that is associated with, and how that code is embedded into the product design, right? So this is, for example, a code called Canage this Canache was a major code for Dior for many years. They've just more recently stopped using it as the main code because it was almost too frequently used. And where did this code come from? It came from the inspiration he had because he saw this print on the chairs of the first show that had this motif. So the code has been used in handbags, but it's also been used in sneakers, in fragrance bottles, in fine watches, in shoes, in accessories, in makeup, and even fine jewelry. And it allows the brand products to be connected into the same universe. And also, it's something that is really inherently Dior because it is based on this inspiration. So, so this is a little bit about some of the key notions of luxury brand management.
That was Professor Sonja presenting luxury brand management. Next up, we have Jamus Lim, Associate Professor of Economics, presenting Asia's emerging markets.
Hi, my name is Jamus, and I am an Associate Professor of Economics here in ESSEC Business School Asia Pacific, and I'm here to share with you a little bit about Asia's emerging markets, especially from an economics perspective. Now, for us to truly understand Asian economies, I think it's useful for us to take a step back in time and to ask ourselves where Asian economies used to be and where they are today. Let me do so by giving you a couple of pictures, and I think these pictures help to illustrate just how far a number of these Asian economies have come. What you see here is downtown Tokyo after the firebombing at the end of World War II. Now, what not many people realize is that at the end of World War II, while most of us think about Hiroshima or Nagasaki and the nuclear bombs that were dropped there, Tokyo underwent a much more severe destruction process, and that was the result of, as it turns out, firebombs. Of course, looking at this picture, you would imagine that it wouldn't be possible for Tokyo to recover from this enormous shock. But what you see here is Tokyo in 2007. And you'll notice, of course, that for any of us that have been there, Tokyo has more than completely recovered from what has occurred. Indeed, Japan, about 5 or 10 years after the devastation that was wrought by the Second World War, completely transformed its economy. And today, it is the third largest economy in the world, having recently been displaced by China. And speaking of China, what you see here, of course, is downtown Shanghai. China had been, for much of the long, millennial-long history in Asia, was a relatively wealthy country. A little bit of that can be seen here in downtown Shanghai, where you'll see the Bund, which is this the edge of the Huangpu River. If you cast your eye to across the river, where you'll see essentially what looks to be mud flats and a swampy area. Now that's Pudong. For many of us that have been to Shanghai in recent times, you would also know that Pudong has completely transformed itself. This is the view from Pudong today. And as you can see, Pudong is not only the financial center of Shanghai, but in many ways the financial capital of the nation of China. Are these two success stories limited to just the large economies in Northeast Asia? Well, not quite. Here's downtown Seoul in 1951 during the Korean War. And as you can see, much of it is unimpressive by many standards, and it looks very much like what you might expect a developing country to look like. And in the 1950s, Korea was indeed very much a developing country. What then happened was that Korea, together with countries like Taiwan, along with the city-states of Singapore and Hong Kong, became the newly industrialized economies. And what did that look like? Well, here is downtown Seoul today, a vibrant, thriving metropolis. Korea is today among the largest economies in the world. And of course, most of us know that that impressive success story occurred in just a span of 40 years. This is being gradually replicated all over other parts of Asia. Here's a picture of Kuala Lumpur in the 1950s before independence. Of course, today Malaysia is still an upper middle income country. And in some ways, it has been trapped a little bit by what economists call the middle income trap, where it's unable to break free from upper middle income status to get into a high income status. But nevertheless, if you look at the capital, Kuala Lumpur, you'll see that it is, in many respects, a very impressive skyline, including some of the most modern buildings. And of course, Malaysia boasts an industry that is competitive by global standards. And while it is still only an upper middle income country, it is a sign of the remarkable progress that the country has made just over the past half century. An even faster rate of growth can be observed if you look further west in Asia, what we today call the Middle East, but what through most of history was called West Asia. This is downtown Dubai in 1980, just before there was a remarkable transformation of its economy as the family there, the ruling family there, made a decision to reinvest much of its oil proceeds into developing the city. That road that you see there, that dusty road, is what is today Sheikh Zayed Highway, and is plied, in fact, by Maseratis and Ferraris and all sorts of expensive cars, in part because Dubai today is a financial center for West Asia and the region, and it has likewise managed to extricate itself from developing status into becoming a impressive and modern economy. Many of us, of course, also know this scene, which depicts Boat Quay in Singapore. If you've been to Boat Quay in recent times, you'll see that it's now surrounded by high-rise buildings, an extremely modern downtown core. And of course, Singapore itself, the country where we are having this conversation, has become, in the span of just 1 or 2 generations, a first world country, having been just a third world country as recently as the time of independence in 1965. What is the common thread that binds all these economies together? And what are the differences? Well, of course, the truth is Asia is an extremely diverse place. The pictures that I showed you illustrate high-income countries like Japan and the newly industrialized economies, as well as the Gulf Cooperation Council countries like Bahrain, Kuwait, Saudi Arabia, and of course the UAE, that have managed to completely transform their economies in a very short period of time to become high-income countries. But there are also, sometimes what we forget, economies that are not as far ahead. China is a good example. Although if you look in the coastal cities like in Beijing or Shanghai or Tianjin or in Hong Kong, you clearly observe modern, globally competitive cities. It is also the case that if you look at other parts of the country, in the inner provinces and in the countryside, you will also notice that China still has quite a way to go. It aspires by 2030 to attain upper high-income status, but as of now, it still is at the border of what would be upper middle income and high-income status. And of course, as I mentioned early on, there are these new wave industrializers, the so-called tiger economies like Malaysia, Thailand, Indonesia, that held so much promise in the 1970s and, to be fair, had multiple spurts of rapid growth. But were never somehow able to break free from this upper middle income trap. And of course, although the world's now 5th largest economy, by some metrics the 4th largest economy, India, is indeed the next emerging giant. It is also important to remember that India itself has many pockets of poverty, especially in the northeast of the country. And there are many areas in the Indian economy that continue to exhibit dysfunction, dominance by a small number of large business houses in the economy, or still nascent financial system. But beyond India, of course, other parts of Asia, North Korea, Nepal, Bangladesh, these are some of the world's poorest nations. The bottom line is that India is, like the rest of Asia, extremely diverse within it, but also Asia itself is extremely diverse. Here's a way to look at Asia from the perspective of the most successful economies. You can see Japan becomes somewhat distorted in the map. And part of the reason why we see this distortion is precisely because it has grown disproportionately and it now has high GDP relative to other countries which occupy, of course, much larger land masses, countries in Latin America or countries in Africa, but nevertheless are underrepresented in the global GDP picture. Unsurprisingly, you'll also see that as much talk as we give to China and India, these do not still represent their geographic borders, and part of the reason for that is because these countries still have quite a way to catch up to global standards in high-income countries. Now, part of what drives this diverse performance in economics is, of course, the diverse institutional structures and histories of these countries. These countries have pursued very, very different strategies for development. Some have adopted much more market-oriented and business-friendly approaches. Countries like Hong Kong, which is routinely cited as one of the most laissez-faire economies in the world, together with Japan, have adopted much more of a Western-style industrialized capitalist model that, of course, has been adapted in their own ways to their own specific idiosyncratic situations. At the same time, you see much more centrally planned economies. Sometimes, looking at China, we forget that the state capitalism that it pursues occurs over an overlay of what we would call still very much a socialist enterprise. And finally, in between, you'll see all the other Asian countries that have pursued different degrees of central planning, of economic control. Countries like India, that up till recently had been a socialist nation. French Indochina, many of these are in transition from their communist past. And of course, if you look at the dominance of the state in economies such as South Korea or Singapore, especially during their rapid growth phases, you will realize that many of the experiences of Asian economies can be characterized by a diversity in their institutional and development strategies. And of course, we also know that these countries have had diverse political histories. Virtually every economy in Southeast Asia, save one, which is Thailand, has had a history of colonization. And beyond that colonization history, we also know that there are much more communist-oriented countries, such as China and North Korea, as well as autocratic countries, such as Saudi Arabia, but also the world's largest democracies. India is one. Indonesia is yet another nascent, perhaps, but nevertheless thriving democratic nation. Now, if you will, let me illustrate some of the common threads amid this diversity. One of these common threads is that a lot of Asian economies have developed with an important stress on what economists call factor accumulation. Now, what's factor accumulation? Well, factors of production are essentially the raw ingredients that go into an economy's production process. We typically think of these as labor, for instance, or when you layer on an educational background to this raw labor, you will have what economists sometimes call human capital. At the same time, you also have physical capital. These are the machines, physical plants, and infrastructure that go into accumulating complementary machinery that can be used for the purposes of production processes. Now, all these factors of production went through rapid accumulation during Asia's rapid growth phases, at least for the economies that have been able to extricate themselves during their development story. So, one example, for instance, is education. If you look at the initial levels of education in the 1950s in economies in sub-Saharan Africa, that's the second set of columns that you see there, or even in Latin America, which is the third set of columns that you see there, you notice that they started off relatively ahead even of economies in South Asia, which is the fifth set of columns that you see there, or even in the case of Latin America, East Asia, which is the final set of columns. Now, what this means, though, is that although they started off relatively ahead, if you look at what has happened by the 2010s, which is the darkest blue columns that you see, you'll see that in many of these Asian regions, they have caught up and in some cases exceeded the performance of these other parts of the world that had started off relatively ahead. So, accumulation of factors of production, at least in this case in human capital, is one big part of the story. You also see this in terms of physical capital accumulation. So what you see in Japan is a story of rebuilding after the devastation of the Second World War. But the same story is repeated in a lot of the other Asian economies once they made a decision to pursue a model of factor accumulation, channeling much of their domestic saving into investment, especially investment in physical capital that can be used for enhancing the productive capacity of their economies. In the 1960s, the then President Park Chung-hee made the decision to pursue a much more export-oriented industrialization strategy, a big part of which entailed channeling much of South Korea's domestic saving into capital accumulation that could be used to enhance its production for goods that it would sell in the rest of the world. Of course, if you look at the TVs in your home today or many of your electronic products, you undoubtedly see brands like Samsung or LG, and that is a testament of just how far this South Korean economy has come in terms of accumulating productive capacity in order to produce goods for the rest of the world. That same story also happened in China. If you look at the panel on the left, you'll notice that in 1992, what happened was China made a decision. The then premier at the time, Deng Xiaoping, did his famous southern tour where he looked at a number of southern cities. And then he cast his eye further afield, looking at Asian, and in particular Chinese diaspora in communities such as Hong Kong and Singapore, observing that these diaspora were able to succeed. And he made that fateful decision to pursue socialism, but with Chinese characteristics, essentially allowing for a much more capitalistic model to be applied to its economic processes. And you can see clearly from the chart a takeoff in the process of physical capital accumulation in China after that fateful decision. Now, if you look at India, you'll see a similar process now playing itself out. In 1991, India went through a very significant financial crisis. And in the 2000s, it then made a decision to open up its economy even more to the rest of the world. And you'll see that story of capital accumulation likewise play itself out in India as well. The reality is, the proof is in the pudding. And if you look at the industrial robots, these are machineries that are used to build other machines, you'll see that 2/3 of the world's industrial robots are located in Asia. Of course, half of that share, 2/3 share, as it turns out, is in China. But you'll see notable shares from Korea and Japan, countries that made capital accumulation a big part of their development story. I will end by pointing to perhaps a dark cloud on this horizon, and that is to remind many of us, or for those of us that aren't familiar, that development story had occurred in much of Asia with unfortunately very little productivity improvements. Economists have a metric for how you would measure productivity after you strip out all these different contributions from these factors of production. We call that total factor productivity. And if you look at total factor productivity, the story is a lot less bright in some ways. So here you see the annual contribution of total factor productivity growth for the so-called Asian dragons, Hong Kong, Singapore, South Korea, and Taiwan. And while that contribution does not look too terrible, it's in the twos, with the exception of Singapore, which has almost no total factor productivity growth, you must keep in mind that these were economies growing at the rate of 8, 9, or 10%. So economies where total factor productivity growth was only contributing a quarter or even a fifth to its rapid growth story. Now compare that to other economies in the West and even in Latin America, and you see that total factor productivity growth was a much more important contributor to the growth story of these economies during their growth periods in equivalent over an equivalent time span. And here you get a hint of why there is a potential dark cloud, and that is, unless these Asian economies, at least going into the future, in the 2030s and the 2040s, unless these Asian economies are truly able to ultimately harness the productive capacities of their economy, unless they are able to elevate their total factor productivity growth, one fears that that rapid growth story will come rapidly crashing down, and this might lead to a slowdown in what had been hitherto an impressive growth story for Asian economies. Thank you for taking your time to listen to a little bit of a lecture on Asian economies, and hopefully you'll be sufficiently intrigued and you decide to join us.
That was Jamus Lim, Associate Professor of Economics, presenting Asia's emerging markets. Next up, we have Rick Marchese, Professor of Management Practice, presenting Valuation and Income Statement.
Hi everyone, I'm Rick Marchese. I'm a professor of management practice in the finance faculty here at ESSEC Business School in Singapore. And I want to speak with you today about valuation and the income statement. A little bit about myself. I teach courses in finance, financial modeling, mergers and acquisitions, corporate finance. I'm also a founder of a boutique investment bank here in Singapore. Previous investment banking experience was at Merrill Lynch and Deutsche Bank in the United States. I'm a chartered alternative investment analyst, and I have an MBA from the University of Chicago. So before we get started, I want to make reference to a quote that I like by Albert Einstein. Everything should be made as simple as possible, but no simpler. So we'll try to focus on the basics here so that there's not a lot for you to remember and you can take away something that can be useful going forward. So why do we value companies? There are several reasons why we value companies. One is to transfer ownership stakes. Corporations use it for mergers and acquisitions, financial reporting, We want to know what assets are worth when they're put on the balance sheet. Fundraising, when corporations go out and they raise capital, they want to know how much debt can we raise based on our valuation. They also want to know if we're selling equity, how much ownership are we selling? Companies also look at valuation when they make strategic decisions in terms of moving into new markets, opportunities into new product areas, etc. Finally, benchmarking performance. How is a company doing relative to its peers? And obviously for legal and tax purposes. So the next obvious question is, how do we value companies? Valuation is dependent on several factors. So if anyone ever asks you, how do you value a company? Your first question should be, what type of company is it? It's going to depend on why you're valuing the company. Are you valuing it for a minority sale, a majority sale? What is the timing? Are you valuing because you need to do a transaction quickly, or do you have time? What's the growth stage of the company? Is it early stage high growth? Is it a mature cash producing company? Where in the world is it located? What industry? Is the industry in or out of favor? Who the buyer or the investors are? Are the investors interested in a minority stake? Are they buying a majority stake? Majority typically sells at a higher valuation. And also, how motivated is the seller? Is the seller selling because they have to sell? Do they need liquidity? Or does the seller have time? One of the ways to think about valuation is the relationship between accounting and finance. If you're familiar with the balance sheet, you may be familiar with the relationship that assets equal liabilities plus shareholders' equity. On the left side, those assets represent investments in the company. On the right is how they're financed. They're typically financed with some variety of debt and some variety of equity. When we move into the field of finance, that equation transforms into something we call enterprise value. Enterprise value is the value of the company or the value of the firm, and to the right is how it's financed. And we look at three things. We look at what is the equity financing, what is the debt financing, and what is the cash on the balance sheet that the company has. So what drives company value? Company value is actually driven by changes in shareholders' equity. So if we go back to that relationship on the previous page, we have total enterprise value, often referred to as TEV, and market value of equity, which is market cap, plus net debt. Net debt is just a term for total debt less cash on the balance sheet. So if you think about it, if a company has an initial valuation of $100 million and it's financed with $60 million of debt and $40 million of equity, and then the enterprise earns $10 million from operations, that $10 million would increase the equity value by that amount. So the equity value would move up to 50 and the firm value would go to 110. So really what happens is firm value is driven by the results on your income statement. So let's talk about the role of financial statements. Financial statements, first of all, provide insights into the performance of a company. You've got a lot of people running around. You've got strategy, marketing, product development, R&D. What the financial statements do is it takes all those efforts and it quantifies the results of those efforts. It helps internal consumers and external consumers make decisions and have insights into the company. The three main financial statements are the income statement. The income statement is important because profitability, net income, is going to drive our equity value. It's going to drive the value of the company. The second financial statement, the balance sheet, tells us how the company is financed. How much debt does it have? How much equity does it have? And who the investors or what investors have claims on that company. Finally, the last one is the cash flow statement. The cash flow statement is going to tell us how the company generates cash. Maybe it's generating it from operations. It could be borrowing money. And what it does with that cash. The cash flow statement is useful because it's like a thermometer on the company. It tells us what the overall health of the company is. It doesn't tell us necessarily the profitability, it doesn't tell us how it's financed, but it tells us how are they generating cash, how much cash they have, and likely how long they would be able to stay in business. So let's talk about the income statement, since we've decided that that's the main driver of value. When you look at the income statement, it's important to understand what the drivers are and how it works. So going from top to bottom, we have sales at the top and we have net income at the bottom. I'm sure most of you have heard people refer to the top line and the bottom line. Top line growth, that's sales growth, and most people know what the bottom line is. That's the revenue, the profit, what the company's making. But when you get into the income statement and you start to dissect it a little bit, there's something there called the line. It's often referred to as just the line. It's the operating line. It's where we have operating income. And the reason that line is important is because everything above that line has to do with operations of the company. It's basically what the company does day in and day out to create value, whether it's selling a product or selling a service. That operating income is the money that they make from doing that activity. Below the line, interest expense, and largely interest expense and taxes, has to do with how the company is financed, do they have debt or not, and their tax, how they manage their taxes. So this is important because when we look at valuation for a company, the way we value a company is going to depend on, are you buying the company or are you buying shares in the company? If you're buying the company, you're buying the operations. And if you own the operations and you own the company, you can dictate how the company is financed. You can dictate how much debt you want to put on it. It can be 100% equity. You can manage your taxes. You can be very aggressive in tax management. So it's very important to understand who's valuing the company and what interest they're taking in it. So valuation. Valuation, we're going to take a little bit of a sidetrack. Valuation is based on three theories. One is asset-based. That's basically just the hard assets of the company. The second one is cash flow-based. The company's ability to generate cash flow. When those cash flows are coming in and what's the risk to those cash flows. And the third one is market-based. Market-based is a relative valuation. So you're looking at the company in the context of what does this company do and how does it perform relative to its peers that may be in the market and already valued. So relative valuation. When we looked at the income statement, and I'll go back here. When we look at the income statement again, what you'll notice is below the line, we have our interest expense. So sales and operating income, also known as EBIT and finance, are above the interest expense line. This means those numbers are not affected by how the company is capitalized. They don't change with the level of debt on the company's balance sheet. When we get to net income, because net income is after interest expense, that's going to be affected by the level of debt that we have. Because of that, numbers like sales and operating income are known as unlevered numbers or operating numbers. They're not affected by debt. The net income number is affected by debt. Because of that, we call that a levered number. It's also called an equity multiple or an equity measure. So when we get to relative valuation and we start looking at multiples for companies, we can categorize them in two sets. There's unlevered multiples or operating multiples, and then there's levered multiples. Unlevered multiples are those multiples that you see, are those metrics rather that you see on the income statement that are not affected by debt. So whether the company has no debt at all or 75% debt, it doesn't affect that sales number. That sales number is a pretty clean number and it's not related to the balance sheet. Same thing with operating income. When we go down and we look at net income, that is a levered multiple. That is affected by debt. The more debt the company has, the more of an impact it's going to have on that net income number. So when we look at valuation and we look at valuing a company, we have to look at multiples that the numerator and the denominator are both either unlevered or levered. So when we look at total enterprise value, think of total enterprise value as the value of a home. Okay, we often compare companies to homes. When you look at a home, homes are valued as a multiple of price per square foot or price per square meter. When you put a mortgage on that home, it doesn't affect your square footage. So that square footage number is unlevered. So when we look at companies and we want to value them, and we're valuing the entire enterprise, we have to look at total enterprise value to sales, EBIT, or EBITDA. EBITDA is just operating income, adding back for depreciation and amortization. We can't have a multiple that is total enterprise value to net income, for example. Why? Because total enterprise value, the value of the company, is not impacted by the level of debt. The value of the company is set. What the debt does is it determines the equity value. On a levered multiple, such as a PE multiple, when we use that multiple, the numerator has to be levered. Okay, so we use market value of equity to net income. We can't use market value of equity to sales. Why? Because the equity value of the company is impacted by the debt. Here's a good example. Now, here are two companies. We have company A and company B. They could practically be the same company. So if you look at the way they're capitalized, you'll see that company A is highly levered, meaning it has a lot of on the balance sheet. In fact, it has $90 million. So the equity is $10 million. Both of these companies have the same value. These could be two houses next to each other. One could have a mortgage for $900,000 and the other one could have a mortgage for $100,000. The fact remains that both companies have the same value. They're both $100 million companies. Company B doesn't have a lot of leverage. Because it doesn't have a lot of leverage, it only has $10 million, you can see the equity value is much higher. It's 90. So when we go to the income statement and we look at what's above the line, the operating performance of the companies are exactly the same. They have the same sales number, they have the same basis. Now, once we go below the line, you'll notice that A, given that it has a lot of debt, has a much higher interest expense. Now, I took the liberty of keeping the interest expense, the interest rate the same for both companies. That wouldn't necessarily be the case. But I want to use this as a tool so we can compare the two. So the interest expense for both companies, I put at 10%. But you can see that it's going to be more impactful, right? On $90 million, they're going to pay $9 million of interest expense, where company B has very little interest expense. Tax rate is the same, so we get to net income. Now the net income below the line is markedly different. Now think about this. If you're an individual and you're buying equities or you're buying stock in a company, you're buying the net income. You're an equity investor. So when you look at these two companies, even though their value is the same, your claim to the company is going to be significantly different. Why? Because company A has more debt, and those lenders are going to have a claim that's senior to yours as an equity investor. So if you're buying equities, you look at a PE ratio. If you go down to market value to net income, you'll see those multiples are different. Market value to net income for A is going to be 10 million divided by the 7, so we get a multiple of 1.5. Company B that doesn't have as much debt, the equity is going to have a higher value. However, if you're buying the company in an acquisition or leveraged buyout, you would look at these companies and you would value them the same. Those are the unlevered multiples. You can see on a sales basis, an EBITDA, and an EBIT basis, they're exactly the same. So how do we apply multiples? Once we have multiples for a company, we want to go out and we want to use those multiples. We want to look at market multiples for comparable companies. So this particular example, we have a company, we have an operating metric. You can see their sales, EBITDA, EBIT, and net income. You can see those operating metrics, sales at 100, EBITDA at 16, EBIT at 13, and net income at 10. Now, we're operating under the assumption that this is a private company, so it's not valued in the marketplace. So we have to look at other companies that are similar to this one. Now, they can be similar in terms of industry, market, business model, growth, size, profitability. It depends. We need to look at, sometimes people call it comparables, but often you have to look at substitutes. What would investors be willing to go into as an alternative to this company? So we've got those, once we identify those comparable companies, we can see valuation multiples above. So on a sales basis, you can see that companies that are similar are going to trade between 2 to 2.5 times sales. On a PE basis, it looks like 16 to 19 times net income. So we take those multiples, you can see relevant valuation multiple, we have a low and we have a high, and we apply those to the operating metrics. So in this case, we have 100 million in sales, we have multiples between 2 and 2.5. That would imply a value of 200 to 250 million for this company. And we look at it on several different metrics. What we're trying to do with valuation is we're trying to triangulate it. We're trying to find data points. Every data point is going to be different, but we're hoping to see a pattern where those data points cluster around a valuation. Remember, valuation is not an appraisal. We're not looking for an exact amount. That's a big difference between an appraisal and a valuation. An appraisal will give you a price. It will give you a price to the pen. Valuation is generally a range. It's a reasonable range. It's of maybe a range 10% plus or minus. But you can see this company, if we start looking at the numbers, you can see on the high end we're looking at 250 million of value, and on the low end 182. So what we want to do is we want to take those points and we want to start to try to narrow that range. On the next page, you can see where we've applied those valuations. So there's something called a football field. And again, it just makes it a little bit easier to digest. It's a graphic, it's a tool to help visualize where we think this company might be valued. We're looking at metrics of sales, EBITDA, EBIT, and net income. And you can see the ranges there based on the highs and lows of the comparables. Now, if I were looking at this and you wanted to kind of pinpoint, a middle of the range, you could reasonably say that this company's value is probably around at least 210 million, all the way up to maybe 235, 240, if you wanted to be conservative. If you wanted to be aggressive, then you could justify a valuation that's probably as high as 245. So I hope this was useful. This was just a sample size of kind of the things that I teach and that our students here at ESSEC learn. If you think this is interesting, feel free to reach out to me, and I hope to see you on campus. Thank you very much.
There was Marchese, Professor of Management Practice, presenting valuation and income tax statement. Last but not least, talking about delivering value through marketing in time of change, Chung, Academic Director of Master in Marketing Management and Digital.
Okay, hello everybody. I hope everyone is doing I'm Tuck, and I'm a marketing professor in ESSEC Business School. So I'm going to spend some time talking about the topic of what is marketing and how does marketing deliver value especially in this time of change. Let me first introduce myself. As I mentioned, I'm an associate professor of marketing in ESSEC Business School, and I'm also a academic director running a program called MSc Marketing Management Digital, which is a program fully run in Singapore, and a focus in digital marketing, luxury marketing, sustainability marketing, for example. My research is in two areas mainly. One is in digital marketing, and the other one in the impact of marketing on the financial outcome of company. To be more specific, my research in digital marketing basically look at data describing how consumers use products, and from that inferences, preferences for consumers, and then after that, try to tailor products which is more suitable, that give more value to consumers. The other stream of research I do has to look at how does marketing strategy affect outcome of a firm in terms of bottom line, in the sense of share price, etc. So basically, that's what I do. So let me dive into what I'm going to talk about today. So first of all, the question is, what is marketing? And the reason I ask this question is because I do get students have never taken marketing before, and when you ask them this question, they almost equate marketing to advertising, which is not surprising at all, because a lot of us might not be exposing to what marketing is, but usually our attention got caught by very good TV commercial, very interesting commercial that's memorable, etc. So a lot of times students might associate marketing with just advertising, but that is not true. Basically, marketing is more than that. If you look at this definition of what marketing is, and I got this definition is from American Marketing Association. So basically, if you look at it, what it's saying is that marketing focuses a lot on value. Understanding what value is for your target consumers, your target customers, and then the marketing is a process, activity of creating, communicating, delivering, and then exchanges value in exchange, of course, for money from consumers, for example. Right, so why am I saying this? Because that's pretty much the gist of my presentation today, focusing on value and how does marketing play a role in understanding how to give more value to consumers, how to understand what is valuable to consumers, right? So the misconception of the fact that marketing is advertising come from this long time difficulty of marketers to basically justify their advertising spend, justifying what they spend on marketing, for example. Back before year 2000, a lot of companies couldn't justify, for example, how much the amount of money that they spend in advertising. In fact, I got this saying from John Wanamaker. Wanamaker is actually one of the pioneer marketing, who started a few stores that eventually become Macy department store. So here's this very famous saying. He say, half the money I spent on advertising is wasted. The trouble is I don't know which half, right? So that kind of showed the problem of marketing last time. In fact, when company has problem balancing the budget, the first thing they'll cut is actually advertising budget, because they have no way to link how much a company spent on advertising to firm performance. Then come year 2000. What happened in year 2000? We have the internet. We have this great ability now to collect data from consumers. And also there's an increase in IT. There's a great ability to analyze data, for example. So now things have changed. Marketing has actually evolved to be a lot more scientific, to be a lot more data-based. So which is why I like to introduce this concept of closed-loop marketing. What closed-loop marketing is basically a virtuous cycle. If you look at the diagram on the left, it's basically you start off with planning your marketing strategy, understanding which group of consumers you want to sell your product to, understanding how you want consumers to see a product in their mind, for example. So it's basically segmentation and positioning. Through that, you can execute your marketing. Marketing means your pricing, the product you introduce, for example, how you distribute your products, and of course how you communicate your product for them. So you execute that, and then you kind of get some form of feedback from consumers, And then feedback would come in the form of, do they like your product? Do they buy a product, for example? Thereby, there's a word conversion. Conversion is basically anything consumers do to make them move closer to buying product. And finally, collecting that feedback from consumers gives the ability to do analytics, right? Some number crunching to understand how well your marketing is doing. And that become a loop to that become, information for you to improve your marketing planning next time period. So basically, this closed loop marketing is basically a virtuous cycle where you continuously improve the way you market to consumers. So notice it's very data driven, and also it's actually basically trying to understand what consumer value, right, based on how they respond to your marketing mix, and then based on that improve delivering greater value to them. So today's a short presentation. There's a lot of things I can talk about marketing, so I'm going to concentrate more on marketing planning and to be more in tune with the topic for today. I'm going to talk about some of the recent developments that I think will affect marketing strategy and planning. So we just talk about planning. And when you do any kind of marketing strategy planning, you have to understand basically the business environment and also how does consumer preference changes with time. So I'm going to talk about a few developments which some of you might be very familiar with. First of all is, of course, COVID, right? So we all went through the COVID pandemic. There's stages of social distancing where we are not able to do face-to-face transaction with retailer, for example. We have to buy things online, for example. We have to then socialize with friends and family through social media. So the implication of COVID is that COVID resulted in rapid digitization of the way marketers do marketing, in the sense that now a lot of consumers during COVID time went online, even for group of consumers that usually don't go online, like the old folks. They have to go online using social media to get in touch with their friends and family. There's a rapid digitization in the sense that a lot of people is buying things online. Social media caught on big time because that's a way to get yourself entertained. That's a way to get in contact with friends, for example. So now, post-COVID, guess what? Consumers are continuing buying things online. Digital behavior that acquired during COVID remains. Social media is becoming really big now, especially among the youngsters. And also now, increasingly, there's a need for firm, to reach consumers through digital media. And other things that happened during COVID is basically the supply chain disruption, in the sense that consumers couldn't get the things they want during COVID period. They're really pretty much forced to buy local products, forced to buy brands they don't buy, they used to buy in the past. So what happened post-COVID is that now consumers have this habit of trying out new products. They are no longer as loyal to the existing product as, hey, I tried other options and they're as good, if not better. So now what it means is that, notice that the challenge for marketers now is that you have to tap into the digital media to better understand consumer behavior, what they want, for example, and then you really have to develop value to consumers to continue develop or maintain the loyalty from consumers. So a lot of us might have written to TikTok video during the social media, right? So what is interesting is that now there's this phenomenon of social commerce, in the sense that now social media is no longer just a platform for you to be entertained and be connected to consumers. Now, increasingly, people are buying products through social media platform. For example, I'm showing this chart of a TikTok shop, which actually got implemented really recently. So basically, it's using social media, right? Using peer influence, using influencers to get consumers to get to know about the products, interact with the products, and then purchase a product, for example. So that's something that you need to think about as marketers in these recent times. So what is unfortunately, is that after COVID has recovered, we get a situation of high inflation and high economic uncertainty. So things are getting expensive, rent are getting expensive, for example. So what it means is consumers are now adapting more smarter shopping behavior, right? In the sense that consumers saying, yes, there's certain things I need now I can't do without. Can I get it cheaper, right? So consumers are turning online to buy things, the same thing they need, but cheaper. Of course, consumers are delaying some consumption in the sense that they are delaying purchasing of big electronic items at home because they're not less necessary. But their daily needs, for example, they're turning into online, they're looking for deals, etc. So what it means is that consumers are a lot more sensitive to deals, right? A lot of you might know what a single days is. Single days result in a huge increase in sales for a lot of brands. And in fact, a lot of brands make most of their sales in this one day alone. Of course, what it means is that single days then evolve into something called double day sales. You got 8-day sales, 9-day sales, etc. So consumers are increasingly responding to promotions. But same time, they're asking themselves this question: should I buy now, or should I delay for the next double day sales, for example? So what it means is that for a marketer, it means that you have to then persuade consumers that, hey, this is a good time to buy. Make it engage consumers so that they'll buy more, etc. Right? Something to think about. So then interesting flip side is this, right? Is consumers now purely about saving money, purely about stinching expenses, not spending on anything else. So what's interesting is that there's this mentality among consumers, something called revenge living, right? In the sense that they say, hey, I suffered enough during the pandemic, so I have to live a little. So there's actually trend of consumers, despite the fact that they're watching their money, they're spending their money on pampering themselves, right? The concept of new luxury means that I'm buying things for experience, right? In the sense that we're paying things to spend on shop, which is experiential, right? For example, spa treatment, going to a good restaurant, for example, right? The trick for marketers then is that how to then convince consumers to spend this money on them, and also identify the segment which is more willing to be spending the kind of money on luxury items, on rewarding themselves. One example that shows that there's actually increasing demand for luxury sales happens in Philippines. So what's interesting is that during the COVID period, the consumers doesn't get a chance to travel overseas. So what it means is that there's money saved up from travel. So once they have this money, you know what consumers say in Philippines? They say, guess what? I'm worth it. I'm going to spend something that of value that, of pampering myself. So there's this revenge spending environment. It's spent on luxury items, right? That's why luxury brands saw a boost in sales. And of course, it's not happening only in Philippines. It's happening in other Asian countries also. So it goes to show, yes, value is important. It's really convincing consumers that my brand is a brand for you to splurge on for revenge spending. Another important trend that happens recently has to do with global warming. So global warming basically kind of sensitizes consumers to why production has to be sustainable. That can trigger consumers to look for not only sustainable option, but healthier options, especially when it comes to food, when it comes to beverages, for example, and purposeful options. Does this brand do good to society, for example? So there's a general awareness, general desire for consumers for more sustainable products. But guess what? A lot of research shows that consumers, despite the fact that they say that they conserve our environment, they are not willing to pay premium for more sustainable products. So the trick for a company then is that, tell consumers what is the trade-off, what are you getting for in terms of paying higher price, in terms of being more inconvenient in your consumption experience, for example, and how does that trade off to more sustainable results. So basically, the idea is actually communicating the trade-off to consumers. So one way that firms to compete, for example, is looking at this. with this increase in online purchases, there's an increase in delivery for online product, for example. And what firm can do when they deliver is basically gives consumers this option, asking them, do you actually need same-day delivery, or could you delay your delivery for a few days, for example? So research shows that same-day delivery, not only is it more expensive for consumers, it has a substantially more impact on environment because you have to speed things to transport things to consumer, for example. So consumers are quite willing to say, hey, I don't need the product today. I'm willing to wait a few days if it means better for environment. So basically, this is a case in point that sometimes the communication value, communication trade-off of what it means for the different product option, different delivery options you have to communicate that to consumers before consumers make the right choice. So by now, you should actually see the gist of what I'm saying. The trend of what I'm saying is basically the whole idea of value, and basically more and more consumers are looking for value. Value in terms of the fact that if my pockets are tighter, how can I make my money stretch more, for example? Value in terms of what is the right luxury product to invest in if I'm going to invest in, for example. So which kind of linked to what marketing do, in the sense that, how can I understand what is truly valuable, what is of great value to consumers, and how can I then deliver that through my marketing. Right? So this brings us pretty much to this slide. Still was marketing. So yes, marketing does more than advertising. Advertising, in fact, is just one component of marketing. So basically what marketing is important is basically understanding what consumer value is. It could be through marketing research, through data analysis, for example, and then use a process to create, communicate, deliver, and exchange value with consumers. Right, which is pretty much what we talk about. I can't end this talk without talking about generative AI, right? ChatGPT, most of us has actually used it to search for information we need. So that really have changed how consumers search for information. But I'm going to talk about it more from a marketer point of view. So does generative AI benefit marketers? Yes, the answer is yes, in the sense that research shows, evidence shows that consumers respond to personalized messages a lot better than broad messages, for example. So what generative AI can really benefit marketers is that you can use it to craft personalized messages to more targeted consumers, simply because the cost of coming up with new content is so much lower now, for example. That's one thing that AI is changing how marketers reach out, communicate to consumers. Another way that generative AI could change is actually change the product itself. The example I show is actually JP Morgan Chase Bank here. They literally use generative AI to create personalized financial plan, understanding, for example, a particular consumer's risk profile, how much return they're looking for in investment, for example, and then come up with pretty much customized product quite quickly using AI. And yes, this pretty much come back to closed-loop marketing. So notice that now modern marketing is so data-based, in the sense that closed-loop marketing is so much relevant now, in the sense that we learn from every time we do marketing, and then improve on the data collected and analyze the data, and then improve it the next round. It's actually a virtuous cycle that we do as a marketers. So that's it. I hope you get a sense of what marketing is and how marketers can do to develop and deliver values to consumers. This is Tak. I'm from ESSEC Business School. Really, thank you so much for listening to my talk.
There was Tak, Academic Director of Master in Marketing Management and Digital. We've come to the end of our mini masterclass. I hope you've gained insights from the different professors and academic directors. Thank you once again for joining us this evening, and we wish you a pleasant week ahead. Have a good night. Thank you.